Verizon reported earnings this morning, and the market has reacted really positively. As I'm recording, shares are up 6% on the day. There's a lot of progress for Verizon attracting new customers, increasing their wireless revenue, but there were actually some negatives that I took from the earnings report. I thought this was a bit of a mixed bag. I am very bullish on Verizon long term. I think that their financial turnaround is just getting started, but there is a long way to go, and there were a few things that I didn't like about the quarter. The market obviously saw it differently, but let's get into all the numbers because there's a lot to dig into with Verizon. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Go to fool.com/ASYM for their top 10 stocks to buy right now. I want to start with the presentation because Verizon always gives similar information each quarter about where subscribers are coming from and going. And so this gives some good context for the quarter. Here is Verizon's operating metrics for the quarter. You can see that there were 3 million retail postpaid gross ads. So net ads is including the losses. On the consumer side, on the postpaid business, they've gone from 3 negative quarters to almost making up for all those losses in just the fourth quarter with 318,000 additions. The business side continues to perform relatively well, 131,000 additions there. Broadband has been something that I have thought is going to add a lot of value to Verizon long term. Fixed wireless is something I've been using for well over a year now, and that continues to be a point of strength. 413,000 additions and 375,000 of those were fixed wireless. This is one of the reasons that I think Verizon is in a relatively strong position. They're able to now bundle wireless broadband with wireless cell service. So you can put all kinds of devices on your Verizon plan. I'll get to some of those numbers in a little bit, but the average revenue per device is not necessarily going up, but the revenue per customer, when you include all of the lines that they have connected, continues to rise steadily. So I think that's exactly what you want to look at for Verizon. The prepaid business continues to really struggle, negative 289,000 subscribers there. If we go to their consolidated financial summary, total revenue down slightly from last year, both on a quarterly basis, which is on the left here, and a year-over-year basis for the full year, which is on the right. But what we really want to be looking at is the red column in here, which is services and other, not wireless equipment. Wireless equipment is typically a loss business for Verizon. So when you buy a phone or another piece of equipment from Verizon, they typically lose money on each of those purchases. They're going to make it up on those wireless services, though. That's why you want to see the service revenue growing and not necessarily hardware revenue. So that is improving slightly, not big increases, but a little bit of an increase there. And then total wireless services revenue is up 3.2% year over year. Not a big increase, but this is a mature business. It's a cash flow business. We're not going to see 10, 15% growth from Verizon. So 3.2%, relatively good growth from a revenue side for wireless service. Here's where things get a little bit more murky in my eyes. Cash flow from operations improved throughout the year, but we're actually down slightly in the fourth quarter. So for the full year, $37.5 billion in cash flow from operations. Capital expenditures continue to move lower, which is a positive sign. $18.8 billion spent there. That means that free cash flow left over was $18.7 billion. Pay out $11 billion in dividends, which continues to go up again. Again, I would like to see them grow that dividend less, at least keep it flat and pay down debt. But that's not what management is doing. They did increase their dividend, and so that's why that payout went up to $11 billion. But you do have more excess free cash flow of $7.7 billion this year than you had last year. So steps in the right direction there. What we would like to see is then debt declining, but that's not what we see. And this is where my criticism of Verizon is for the quarter. $150.7 billion in debt, 128.5 of that, which is unsecured. You have less cash than a year ago. So unsecured net debt went down slightly, but not even as much as the free cash flow that was available to pay down debt. And there's a few reasons for that. They contributed to pensions. There were some other what they call one-time expenses, but these always seem to hit in the fourth quarter. So these are more recurring than they are really one-time expenses, especially when you have things like pension contributions that you have to true up. You have to make sure that they are where they need to be at the end of the year. When you look out for guidance for 2024, they expect total service total wireless service revenue to grow 2 to 3.5%. Remember, that's what you really want to see growing because that's where the high margins are. So relatively good growth rate. Adjusted EBITDA, not quite going to keep up with growth. So we're seeing some of those higher costs involved. And then adjusted earnings per share, $4.50 to $4.70. And CapEx going to decline again down to $17 to $17.5 billion. I'm going to go through some of these cash flow numbers because this tells where the cash flow fell short a little bit in the fourth quarter. There's a lot of numbers here. So that you read these left to right, which is not always the case in financial statements. And then each of these quarters in the year are a summation of what happened before them. So this makes it a little bit confusing, but you can see that net income was actually negative because of some one-time charges. The biggest impact was this impairment for the Verizon Business Group. That was $5.8 billion in the quarter. Obviously, a non-cash charge is a write-down of goodwill. So not something you want to see in a business, but it makes the net income look a little bit worse compared to what free cash flow was. Depreciation and amortization, $17.6 billion. That's going to be something you expect. But there was a few other things that caught my eye. One is you have these deferred tax assets. So that's an increase in cash, despite the fact that you're recording that on the income statement. If we move down here a little bit more, you have on the investing activities, acquisition of licenses. So continuing to spend money on wireless licenses. And this is, a few $1 billion here, a few $1 billion there, but this is why debt doesn't end up coming down for Verizon. So the cash flow statement is solid, I would say, but not improving maybe in the way that I would like. Consumer business, this gives you a little bit more of an idea of what's going on within the business. Remember I talked about wireless equipment is a negative margin business. Well, last quarter, $6.4 billion in revenue for wireless equipment. The cost of that revenue was $6.9 billion. So losing over $400 million on selling hardware to customers. Now you're making it up because service revenue, $18.9 billion, and the cost of that revenue is just $4.4 billion. So that's where you're making it up. But here's the thing that I start to get worried about with Verizon is there's some of their spending. Their selling, general, and administrative jumped to $5.3 billion. That's the reason that you see operating margins, scroll down a bit more, falls to 26.1%. So that's a pretty sharp decline in the operating income margin. We see a similar decline in EBITDA margin. Now remember, this is on the consumer side, so this is only part of the business, but we want to see this moving in a positive direction, not moving lower for the fourth quarter. This is the other thing I highlighted earlier was average revenue per account, which Verizon discloses here, and average revenue per user. Average revenue per user been relatively flat, $31.87 in the most recent quarter. That's up a little less than $1 from the first quarter of 2022. But here's the good news. Look at average revenue per account. First quarter of 2022 at $123.96. Now that's up to $134.10. So increasing prices just by simply increasing the number of devices that are on an account. So this is where something like fixed wireless becomes an advantage because you're not going to be necessarily increasing prices on cell phones by somebody adding fixed wireless to their account. You may actually be giving them a discount on some of those existing services, but your incremental revenue is going to be higher when you add some of those new services like fixed wireless. The business segment, you see some similar trends. And this is the one thing I want to highlight here is the operating income margin falls from 7.2% to 5.8%. And this has been in a steady decline over the past 2 years. So this is an area where I'd like to see some improvement in those margins. But again, they're spending a lot of money on SG&A expenses. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Here's the final thing I want to cover, and this is the reason that I'm so focused on debt for Verizon, and I want to see that debt coming down. Look at interest expense. And what this does, this is full year 2021 on the left, full year 2023 on the right, and then you have each of the individual quarters adding up to those full year numbers. So what you see is 2021, $3.5 billion in interest expense. That goes up slightly in 2022 to $3.6 billion. But then look at what happens in 2023. An increase of almost $2 billion in interest expense to $5.5 billion. So as interest rates continue to remain higher than they were for most of the past decade, we're going to see this interest expense continue to go up. That's going to pull cash flow out of the business. It's going to mean less ability to pay down debt, less ability to keep that dividend growing, and less ability to reinvest in buying more spectrum and growing the business. So that's why I'm so concerned about the debt level, because this interest expense is just going to continue moving higher. In a lot of ways, this was a steady as you go kind of a quarter for Verizon. There was incremental improvements in a lot of different areas. We started to see more customer additions. Now that's going to take multiple years for that to really pay off financially. You're making that investment up front in both sales and marketing, and those losses from hardware sales in the anticipation that you're going to make that up over the next 1, 2, 3 years with that high margin wireless service revenue. So that would be the flip side of some of my critiques here from Verizon's earnings report, that we should see some of those operating cash flow numbers improve over the next couple of years because they are now adding customers. But there does seem to be an ebb and flow in the business. And what I would like to see is more steady improvement in operations, in the amount of wireless revenue, in the losses that they're generating from some of those hardware sales. I know that's difficult for a lot of these companies because you have to have promotions to bring people in the door. But at the end of the day, losing that much money on hardware sales is really tough for the business. And they got to reduce that debt. You have to be able to reduce debt as this 5G network starts to mature, because if you aren't reducing debt now, what are you going to do when you have to invest billions more in 6G and in acquiring more wireless spectrum, in installing new equipment? So we'll see if they turn that corner in 2024. It looks like the free cash flow is going to continue coming into the business, but I would just like to see them de-risk the business. The market seems to disagree. That's why shares are up, and they've had a really nice run over the last 6 months. So I think buying in at a really good valuation has been a really good move for investors, but now it's time to start improving those operations and the free cash flow in a little bit more meaningful way. But what do you think about the results from Verizon? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.